As you know, the Tayarisha African Center of Excellence for Digital Governance has been running a series of lunchbox discussions where we give individuals the opportunities to really just tell us about their research, the work that they're doing, and create a space in the community where we can engage and communicate with each other. So today we've got Dr. Onkokame Mothobi, who I was telling him before that I've heard a lot of good things about him. And today I get to see him in action. And I'm very excited about that. And he's going to be presenting is it a full paper now? Because you've done the research already. His paper that's titled Digital Finance and Financial Inclusion in Sub-Saharan African Countries, Does Regulation Matter? And I'll let him talk about the paper more in detail, but there's a lot of questions that come out of here about what mobile payments look like on the continent, what e-wallets look like. You hear about what's happening in the States when people talk about cash apps as a way of transferring money in between people, and you have M-Pesa. Whereas in other countries like South Africa, the regulations that are in place make it nigh on impossible to create those types of solutions a lot of the time. So he'll be talking more about that with us. As a brief introduction, I did ask him whether I should read his whole bio, and he politely said no. But I do think it's important to acknowledge that Dr. Mothobi holds a PhD with a focus on industrial organization, game theory, and econometrics from the University of Cape Town. He also has a master's in economics as well as a BA in economics and statistics, and a BA in social sciences, which were all obtained from the University of Botswana. Dr. Mothobi has consulted for several different African governments, including Nigeria, Uganda, Lesotho, and Swaziland, and he's been actively involved in developing strategies and assessing South Africa's digital futures and readiness. So we are very excited to have him on board. We're having more people joining us now, which is always exciting. So I will hand off to Dr. Mothobi to give his presentation. And if there's any challenges, just put it in the chat if you can't hold us or if there's anything odd like that, and we'll make sure we sort it out. But thank you so much.
Thank you, Chair, for the nice introduction. Yeah, my name is Onkokame Mothobi, and I just joined the Tayarisha Center here as a postdoc fellow. And my work here will be on digitization and international trade, and also looking at issues of economic growth and payments. So the paper that I'm presenting here, it's part of a series of papers that I have been involved in. Some have been published, and some I'm working with other colleagues from other universities. We are still, two of them are yet currently have been submitted. And this is one of the papers that I worked on that I'm still working on to publish later. And it's titled Digital Finance and Financial Inclusion in Sub Saharan African Countries. Does regulation matter? So in this particular paper, this is one of the aspects that the regulation aspect that I would have to really infuse in it and work on it to actually have that particular aspect of regulation. Because this is because in a number of papers that we have presented, there have been this issue of people getting interest on issues of regulation. And I'll talk about a few on this once I'm done presenting the whole paper. So, as we all know that in past decades or in the last decades, we have seen an exponential growth in adoption of digital technologies, which were mostly led by adoption of mobile phones and later on smartphones, which in effect led to increase in internet use in most of developing countries. So ideally, there have been research, growing research, which looks at the effect of adoption of these digital technologies on economic growth and just on individuals. And empirical research shows that adoption of mobile phones and internet had a remarkable input on economic growth and performance. A number of authors, as stated there, have identified three channels through which digital technologies can stimulate economic growth. First, they argue that it accelerates productivity, and innovation by improving access to information and at the same time reducing such costs. Jorgensen was argued that these digital technologies can also improve social well-being through increased social interaction. And this is mostly seen on a number of platforms such as Facebook, Twitter, and all those platforms where people can actually interact, whether they interact at individual level or they interact with businesses and government. So, and it also improves social well-being. So, in Africa, where more than 33% of people live in extreme poverty and 36% are illiterate, adoption of digital devices has the potential to actually serve as virtual infrastructure for provision of services that are generally not available to the poor or that are not available in remote areas, mostly because business sectors could not invest in those areas as there are few people in those areas and profitability in those areas are very low. And the exponential growth in adoption of digital technologies and services in Africa has increased access to online education, health, agricultural programs, and digital finance. And the current study focuses on the latter and aims to investigate the effect of coverage and regulation on adoption of fintech and financial inclusion in Sub-Saharan African countries. So we explain digital finance as includes all financial services that are provided via mobile phone, computer, or internet. And these services allow individuals to transact and access credit facilities without the need to visit a bank branch. And at the same time, they can increase the speed of payments, reduce costs, while at the same time, it has been found to enhance security through digital accounting. They also provide entry to formal financial assistance for those who have been excluded, especially those who live in rural areas and the poor, and also promote increased savings and allow users to smooth consumption against small adverse shocks. So in general, these services provide an opportunity to promote financial inclusion by linking the poor with cheaper and innovative platforms that allow them to save, get access to credit, and also be able to insure either their business or themselves. And therefore, we can argue that digital services have actually opened doors for the poor who were previously excluded from orthodox financial services to have access to payment system, savings, and credit facilities. So I will now give the context of the banking sector in Sub-Saharan African countries. So generally, the banking sector in Sub-Saharan African countries is undeveloped. A study, or according to the data that we use in this study, only 29% of people in Sub-Saharan African countries have a bank account. However, the introduction of digital financial services, especially mobile money, have contributed significantly to increased financial inclusion in these countries. Data by Dominic Kant and others that was collected in 2018 shows that between 2014 and 2017, the share of adults who have an account with a financial institution or through a mobile phone rose globally from 62% to 69%. In high-income countries, however, 94% of adults have an account, and therefore, when we look at this, it shows that indeed there are a lot of people in Africa who are still not who are still excluded from the financial services. And the main reasons for low levels of formal banking account in Sub-Saharan African countries are infrastructural deficit, inaccessibility, and financial illiteracy. The internet and mobile phone-based technologies actually can change this situation by enabling the excluded to make use of digital financial services. In this way, they can overcome the problem of poor infrastructure and expensive traditional banking model. Despite this, there are very few studies that actually investigate the effects of this technology on financial inclusion in Sub-Saharan African countries. And the current study seeks to investigate how mobile network coverage influence adoption of financial digital services and how investment in network technologies might impact financial inclusion in these countries. The study relates to a number of studies that have been done. The first strand of literature, which looks at financial inclusion, and then the second strand of literature examines the determinants of financial inclusion. And then there's been also a growing body of literature that actually looks at infrastructure availability and adoption of mobile money. For instance, Mothobi, I think this was in 2017, conducted a study in Sub-Saharan Africa where they actually looked at how the availability of infrastructure. In this particular case, they measured availability of infrastructure by looking at using a data called that was obtained from the US satellite, the night light intensity, which was actually used to measure the growth at development at a particular area where a household or individual resided. And then it showed that where there's a lack of infrastructure, people tend to adopt mobile phones. And then there's also another study that we are currently involved in, where we are looking at distance to towers, which we kind of built on in this particular study. So in order to do the study, we combine 3 data sets, which is the survey data conducted by Research ICT Africa in 2017 in 9 African countries: Ghana, Kenya, Mozambique, Nigeria, Rwanda, Senegal, South Africa, Tanzania, and Uganda. And this data contains information about the geolocation of households in all these countries. And then we use those geolocation in all those countries to actually combine this with the night light intensity data, which we use to measure the level of development in a particular area. And then lastly, we use those geolocation of the households and the geolocation of cell towers, where the towers here would be the 2G towers, 3G towers, and the LTE towers. And then using the coordinates, those coordinates, we calculate a Euclidean distance between the 2 towers, which then we use to measure how far an individual is from a particular tower. So ideally, this would be how the world looks like in the night. And as we can see, it actually mimic the level of development across continents. As you can see, Africa here looks much darker in the night as compared to Europe and other countries, where you can see that it's much lighter in those other countries, in those other continents. But even if you look within the African continent, when you look at South Africa there, you can see that South Africa is much lighter compared to other countries. And therefore, we use this data to kind of measure the level of development. But now, in this particular case, one of the interesting aspects is that we have the location of a household, and therefore we can measure the level of intensity of light at that particular household. So that's what we use to measure the level of development at that macro level. And then the other data that we use would be information like how far a household is to a road network. And then, as I've already mentioned, we also measure the distance of household to GSM towers, UATM towers, and LTE towers. And this table here gives us an average distance in terms of Ghana, Kenya, Mozambique, Nigeria, and others. And what we can see here is that in terms of development, countries that are relatively developed than others tend to have their distance tend to be, average distance tends to be smaller than others. But we can see that in terms of the different networks, LTE in this country is still very less developed. We can see that the average distance to household is much larger as compared to GSM and UMTS and network services. So now this is the summary statistics of all the variables that we consider here. We consider gender issues, whether individuals are married, and household size, and other variables that measure assets and wealth. So, and this is how this share of people. So in the next part of the paper, what we do is we conduct a simulation exercise, or I conduct a simulation exercise where I assume that everybody lives within 2 kilometers to a tower. The reason why we are doing this, or I'm doing this, is to be able to find what would be the impact, more like I'm creating a counterfactual simulation exercise to see what would be the impact of investments on networks and ensuring that everybody is covered by this particular network. So this is how currently or our data looks like in terms of people who live within 2 kilometers. But later on, then I will move everybody in the sample to a 2 kilometer radius and then see how that impact my coefficients. So in order to do this, first there are two things. In order for an individual to adopt a digital finance services, they have to have either internet or a device. So to be able to account for sample selection, we use a Heckman model, which allows one to estimate a two-stage procedure, where in the first stage, we allow an individual to choose whether to adopt a digital device, and then in the second stage, and then they can choose, it's a choice also to adopt a digital financial services. So in the first stage here, people choose on digital devices. With the digital devices, it would be we develop a variable that includes internet, computer, and then laptop, and then the mobile phone. And then in the second stage, we model this using where our YI becomes our digital finance services. And the digital finance services here would be whether someone is using internet banking, mobile banking, or any other platforms that would not require an individual to visit a bank. So I'll not dwell much on the methodology here. I'll just pass. So in empirical model, this is the first stage where we have the device here, the choice model. We assume that individuals are maximizing their utility. It's more like a maximization procedure where individuals are maximizing their utility, and their maximization of utility is based on the choice of whether they choose to have a device or not. So what we see is an outcome. Remember, we cannot model utility, or we cannot get to measure utility. So what we see at the end is an outcome, whether someone has, like an outcome in terms of a choice, whether someone has chosen to have a device or not. And therefore, we believe that that process leads to actually a maximization of utility. And then we have XI there, where we now have all the variables that I have defined in table 1, and then we have towers there. So, and then in terms of the second stage approach, still the same, we allow individual to choose. But here, the thing is we are controlling for the sample selection in the first stage by including what we call what we refer to as the males inverse ratio. So this HXI there is the inverse males ratio. So now this would be at the results, and what we see is that first is individuals who live closer to towers are more likely to.
Do you want to zoom in a bit more so they can?
Yeah, I'm trying to find out.
You exit the full screen, so if you just press escape.
Mm-hmm.
So we're just making sure that you guys can see the results. Let's just hope.
Is it this one?
Wouldn't lazy.
Yeah.
There we go. Yeah, that's enough clear. Okay. Maybe just present like we don't need to go back to full screen. It's fine like this. Perfect. Thanks so much.
Okay, thank you. So this is generally our results, and in nutshell, what we see is that as the distance to towers gets reduced, as we see that there's a negative sign there, people are more likely to either have a mobile phone, have a digital finance account. So what one can say from this result is that coverage seems to be a very critical aspect of financial inclusion, in the sense that like as distance becomes smaller and smaller between households and towers, then we kind of see an increase in financial or adoption of financial services. But the result shows that in magnitude, the UMTS and the GSM tends to have more effect than the LTE towers. And this is because in most of Sub-Saharan African countries, digital financial inclusion are mostly led by mobile money, which does not require an individual to have an internet connection to use them. And at the same time, we see that there seems to be a bit of, like males are more likely to be digitally financially included than females. And then at the same time, households that are large are less likely to be financially included than those that are small. While, those who are employed, of course, are more likely to use these digital financial services than those who are not employed. But one of the interesting aspects is that we find that the digital financial services act as a substitute to the poor, but they are more of complementary to those who have banking accounts. Now, in our counterfactual simulation, what we did was, like I said before, was to assume that everybody actually lives within a space of within a radius of 2 kilometers. We assume that everybody lives within a radius of 2 kilometers. And then what we find out is that this would have a positive effect on financial inclusion, with more effect observed in countries such as Mozambique, Rwanda, and I think Tanzania. And we find that now this is where the regulation aspect comes in. And we find that here there are different countries, like we have South Africa, Rwanda, Kenya, Senegal, Tanzania, Uganda, and Ghana. And these countries have different regulatory framework. A country like Nigeria, where they require one to have a bank account before they can have or open a mobile account, we find that the effect of coverage is very low. At the same time, in South Africa, where the regulatory aspect have led or allowed innovation to be within the bank-led. Innovation in South Africa is more bank-led than mobile network operators. We find that the effect of mobile money or digital finance that is being run from the mobile money aspect is very low. But in some other countries such as Kenya and Tanzania and Uganda, where the regulatory aspect allows for the mobile money to be network-led, we find it to have more impact than in other countries. And in general, or in conclusion, what we're seeing is that financial inclusion that we have seen, or the growth in terms of that we have seen, or that has been talked about by a lot of people, it's mostly led by mobile money. And however, it has some other issues in the sense that it does not necessarily provide full financial inclusion, in the sense that some providers of mobile money does not necessarily allow individuals to borrow, while it allows them to save and smooth their consumption during the time of during hard times. It does not necessarily allow them to smooth their consumption by allowing them access to credit. Thank you very much.
No, thanks so much for that. Really fascinating. So many questions. So let's open it up to the group, those who are both here and who are online with us. And yes, we do need a round of applause, don't we? So I just can't see. There we go. I'm not sure if there's any questions from those who are online or anyone inside. I mean, I have a couple, but you may not hog the space. I guess I can get things going as you get the hands up. So if you do have a question, just please put your hand up. But Dr. Mothobi, I mean, I think your research is interesting. I've got questions around the methodology and and the data usage, and I think it poses interesting questions. But there were two things that kind of struck out from your analysis. The one was around large households and males being more predominant in using mobile applications, or not mobile applications, but these digital financial tools. And I'm trying to figure out why males in particular over females in a household. And I just want to hear your thoughts on that. And then more importantly, why a big household is less likely as well to be using these types of digital tools. I also, maybe there's an obvious thing I'm not aware of, but just hearing your thoughts on that would be quite nice. And then Lastly, I think the regulation aspect is hugely important around what we consider innovation within the space. So I have a pen for him. What we think of as innovation within a space. Obviously, in South Africa's financial sector, a lot of our mobile money innovations happen within banks. And whenever an innovation happens outside of a bank, it gets swallowed up by the big banks. So when you look at a snap scan, for instance, which had the potential to really disrupt the payment service system in South Africa, immediately, as opposed to threat, Standard Bank bought it and then shelved it on the side and said, please behave over there. So is there a benefit, I mean, when it comes to innovation, of having bank-led innovation or mobile operator-led innovations, or whether there's a third category that exists? Okay. Yeah, go ahead. Also, you have more questions.
Oh, thank you for the questions. So I think the first issue talks about the exclusion issues. And I would say here, based on a number of studies that we have also done, there's evidence that these digitization aspects build on the historical institutions. We know that in terms of whether you talk about employment or anything, for instance, you find that males are more likely in terms of earnings to earn more than the females. And remember, like we said, these digital aspects in terms of digital finance require an individual to have digital technologies. And when you look at even from the adoption of digital technologies, you find that the poor families or the poor individuals are less likely to own the digital devices. For instance, if you look at issues of smartphone adoption and just basic phones, you find that some individuals cannot afford smartphones. And this builds on the income inequalities that already exist within the population. So this is what, like, it's a similar, like our results, kind of mimic what the society looks like. And I think that is why we are having larger households. And we know that in most cases, the household size is relatively related to income, where larger households or people with the educated, those who have money, the relatively richer are more likely to, their household size are more likely to be less as compared to the poor who tends to have a larger households. And in that particular case, you find that they will either lack the devices, and therefore they are less likely to use digital services. Now, in terms of the regulation aspect, I think what we have seen in terms of, I'll talk it from the mobile money perspective. We have seen the mobile money revolutionizing the financial sector in Kenya. And with majority of people who were not financially included being now able to at least carry a transaction. But remember, that transaction was just a matter of sending money across. It was not providing them with things like savings and credit. But later on, through the development of the mobile money services, there were some other services that were allowed to, partner with banks and provide credit through home sharing and all those platforms. Now, despite in Eastern Africa, we're seeing that exponential growth of mobile money. That is not the case in Southern African countries, where you know that South Africa is playing a very critical role in defining the markets in Sub-Saharan in SADC countries or the SADC countries. And then at the same time, you have the Nigeria side. So there are three things that you can pick from there in terms of regulation. Where the mobile money was mobile network led, we now tend to see a lot of adoption of mobile money services. But where in Nigeria, where individuals were asked to open a bank before they can, or required to open a bank account before they can open a mobile money service. Now, mobile money never took up in that in those countries. Now, in the Southern African region or the SADC region, the thing is, when you look at the banking sector is very competitive and innovative. At the same time, when you look at the adoption or household or individuals that are financially included, compared to the Eastern African countries, you find that majority are on the formal banking system as compared to those. And because of the competitive nature of the banking sector within the South African market, it therefore did not allow for these other new innovations of mobile money to grow. Yes. So that's what I can talk about in terms of regulation.
Yeah. No, thanks so much for that. I'm not sure if there's. Yeah, go ahead.
I'm just wondering in terms of regulation around open banking. It'd be interesting to see how that is affecting financial inclusion. I don't know if you've looked into that. You know, some of those countries that, I mean, I'm going to assume there's a correlation between.
I didn't get that.
Open banking.
Oh yeah, we'll take that question.
I'll take that one after.
Yes.
Like I focused on the question.
Oh, sorry.
No.
I'm just interested in regulation around open banking, how that might be affecting financial inclusion. Has it been taken into account? We're looking at all these other factors, but you know, perhaps that's something that's influencing why it's not really about, you know, banking led, but it's around regulation. It's just not allowed, the regulation is not allowing more innovation to happen outside of banking because of, you know, the closed systems.
Yes.
Just wondering what your thoughts on that are.
And so let's take one of the questions from Rose as well, just so we have a collection. Rose, I'm sure it's Rose. Can you hear us?
Yes, I can hear you. Can you hear me?
Yes, loud and clear.
Hi, I think perhaps I'm picking up on the things that, you know, you're already hovering around, but I'm wondering if a lot of this is dominated by cultural, maybe patriarchal or almost paternalistic attitudes in our regulation. You know, you were saying, looking at your data, there's that male, you know, a male influence in males have the accounts, not the woman. And perhaps that's related to the nature of our society, which tends to be more patriarchal and male dominated. And then that made me think about, you know, the role that regulation is playing. And I don't know, maybe I just want to toss out there this idea of, you know, our banking rules, things like FICA and all of that kind of thing, is, from my understanding, is presented as almost protective of the individual, you know, preventing an individual from getting into all kinds of financial trouble and being preyed upon. But is that actually the reality, or is it actually that this is just another extension of almost like a paternalistic attitude, you know, almost like a big brother, you know, we as the government know what's best, how much you can afford to spend where, etc. So I don't know, I'm just sort of mixing it up a bit.
Yeah. And then can we just read out Geshu's question? So Geshu had a question about financial inclusion as measured by mobile access and services. In economic terms, is this just about expanding consumption markets in Africa, or are there connections to growing income, livelihoods, or innovation capacity? She's also curious about large household size as a negative factor and why that could be. So very similar. So yeah, no, Dr. Mothobi, do you want to go ahead and answer the 3 questions?
So I'm trying to understand Geshu's question. A question about financial inclusion as measured by mobile access and services in communities. Okay. I'll start with trying to address Geshu's question. I'm not sure whether she's asking how do we measure financial inclusion in this study. So I'll take it from that perspective to say she's asking how are we measuring financial inclusion in this particular study. Yes. So financial inclusion is measured by access to either a mobile money account or having any of the digital accounts. And clearly, if we have a digital account, it therefore means that we have a bank account. In terms of digital having, you know, digital account, it therefore means you have internet banking, all those things. It means you have an account with a bank. So I have actually compressed or combined the 2, that is mobile money, and then digital accounts. And this is because over the years we have seen the mobile banks, the banking sector trying to come up with new services that tries to counter the services that are provided by the mobile money. For instance, today we have something called e-wallet, where an individual who has an account can actually transact with someone who doesn't have an account with a particular bank. So one can simply transact money and put it into someone's e-wallet, which use that person's number, and then you just go to an ATM and cash that money. And that person who cashes the money does not necessarily have to have a bank account. So in this particular case, we are measuring financial inclusion from that particular perspective. But in the first section of this paper, what I'm doing is I'm trying to measure how coverage in terms of distance to networks affect adoption of these services. Then in the second aspect, what I do is to say by how much would individuals who have this account increase if everybody is covered by networks. So that's where we now talk about financial inclusion issues. Now, there's a question on why larger households have a negative effect. And I think, or have a negative sign. I think economically, one can assume that larger households would tend to adopt mobile money services so that they can be able to transact. But I think there are other issues that are involved in terms of their wealth status and all that. And I think there's one study that we did, and it showed that actually, like I also showed in this particular paper, that these services are more like, to some, they are substitutes, and to some, they are. So, for instance, you find that individuals the richer individuals would transact with poor individuals using this particular services, while transactions within the richer only happens across the banks. So that is one of the things that I haven't discussed here, but it's one of the findings in this particular study. So, and then there was another issue that talks about the patriarchal tendencies of our governance, I think. And yeah, that's what I was talking to when I say what we tend to observe in terms of exclusions in the digital space, kind of mimic what mimics what the society looks like. And our society, in terms of all regulation and everything, tends to be more patriarchal, tends to favor men than female. Like in some countries, you find that when you ask individuals why don't they have a bank account or why don't they open a mobile money account, they will say the husband does not allow one to have a bank account, or as according to their culture, their culture is that men are more like men are the ones who are in charge of finances than females. So those are some of the things that ideally we are not able to capture by quantitatives, but we capture them through qualitative research. And then there was an issue on, I think, about bank-led innovations, whether does the regulation allow innovations to be outside the banks or within the banks. And I think those are some of the issues that are currently we are observing. For instance, I think in South Africa here, innovations are mostly bank-led. And you find that, and I think that's just what Nigeria also was trying to do, to say this innovation of mobile money should be bank-led. And in most cases, I think it was an issue to try to protect against what you call this money laundering and all those other aspects.
I mean, like we in South Africa in terms of, and the rest of the world is opening everything up. In terms of the data that the banks have, banking as a platform as opposed to banking as a service.
Yeah.
So I'm saying, like, I'm assuming we will get there one day. But it was just, it's just interesting, like if you think that would actually be something that changes the inclusion, the level of inclusion.
That is, if we allow banks to be.
This open they want to open up, the banks have to provide to open up the API so that other third parties can tap into the.
Yeah. I think it will have a positive impact on issues of financial inclusion and innovation, actually. Because I think what you're talking about is issues of interoperability, right? If we are to allow other players to, use the systems that the banks have and innovate within that particular space, definitely that will have a positive effect on financial inclusion and allow other platforms to actually tap on this the bigger infrastructure that the banks have. I hope I understand that.
Yes.
So we are quickly running out of time. I'm very tempted to open up for last few questions. However, I did steal time away from Geshi at the beginning of our session, quite unceremoniously, who needs to give us an update on the center. So before I give off to Geshi, I just want to say thank you to Dr. Mothobi. I think this research is fascinating. We're definitely going to have to coffee with each other to discuss it more. I think it poses interesting questions around what innovation looks like on the continent, whether innovation actually can break cultures, in any particular way, because if innovation can't do it, then what are we doing? I guess. But let me give over to Geshe. Again, apologies for stealing your time. You may reclaim it.
No. Thanks, Professor Fetse, and thank you for hosting today. Thanks, Onkokame, for an excellent presentation. I'm only sad that Halfdan is not here. He's always complaining that we don't have enough quantitative research that's done. So I think he would really have appreciated this particular presentation. So we do try to use these sessions just to give brief updates about what's happening in the Tayarisha Center, and it's really great seeing, I think, people returning to these lunchbox opportunities as a space for just sharing the various research people are doing. You'll see we've tried to have a mix of where we've got students, postdocs, lecturers, even others presenting. So please do be in touch with Zibusiso if you would like to get on the 2023 lineup, which is already looking hot. But for now, I think we can say that on November 3rd is going to be our next lunchbox. A bit tighter. We try to do these monthly, but because we missed a date somewhere in between, we're trying to catch up. So we'll have Prof. Mary Carmen, who's actually from the philosophy department, coming to share. And I believe her work is around digital ethics, digital earth governance, and interesting sounding things. So it'll be quite exciting if you are able to join us on the 3rd. Not quite a lunchbox, but somewhere in between there, we'll also have Michael Onyango from Kenya coming on November 21st in person at WITS, but we'll also see if we can stream online. And that will be just around the digital governance work in East Africa and some of the possibilities around engaging with governments and innovating in the digital space. So please do be in touch if you have topics and contributions you'd like to make on this platform. We'd like to see it being open to everyone. Last time we spoke about the call for papers we were putting out around the Hans Seidel project, which is around African, I can't remember the proper title. Can anybody, something? Oh, Onkokame, you should know. What is it? African something in the digital age?
No, African digital governance age. Yeah.
Yes, the problem with clever titles. We need an acronym. So that call for papers went out. We were really excited to receive 67 abstracts from around Africa in just like 2 short weeks. And so poor Professor Fetse and Onkokame and Halfdan and myself have been having to trudge through that. We have 20, we think, excellent abstracts that were selected out of really a great pool. So we actually hope that if we have a future such call, that we can anticipate such positive response from the scholarship community. So watch that space. Hopefully towards the end of the year, we'll beginning to see papers coming out of that. And next year, we begin having actual dialogues around that content that's emerging and a book that will also come out of that work. But also hopefully some creative engagements. We are actually putting out a tender. Is it today, Zibusiso? Around some kind of a comm strategy. We're trying to be not so academic and realize that we have to communicate and engage better. So we're going to try and get some support. When is it, Zibusiso? Today?
Yeah, it went out today. Closing date is 27 October.
Great. So if you know any people who are great at not just doing research, but communicating and particularly engaging with public audiences of various kinds, we can certainly use support in that. And then maybe just final point, just to say that one of the other things the Tayarisha team was doing this month, in fact, just until last week, is we had a delegation that I think includes some of the people on this call that attended the IceGov conference in Guimarães. I should be able to say that, Guimarães, I think it's now called, in Portugal, which is the sort of e-governance conference. And hopefully those papers will be up soon. There were quite a range, I would say, in terms of the quality and on type of content. But I think those papers, I'll put the link here for the conference, but I think the papers aren't out yet. So that'll be something to look forward to. And I'm sure with Zibusiso, we can share with you once the actual papers are loaded. But we got to attend a lot of sort of research sessions there. We also then did a study tour in Denmark with a government delegation as part of the SA-EU dialogues that we've mentioned to you before. And that's a process also where we'll be able to share sort of reports and findings and what next. It was quite exciting, I think, just to learn from Denmark as the country that's rated the highest on the number of digital governance indices. But also interesting to see where we are not so bad, which was also another interesting finding perhaps from that trip. For me, a big takeaway was how we make sure that we are contributing to building the ecosystems, not just the individual capacities, I think, around digital governance, that doesn't make enough of a shift, that one really has to take the ecosystems approach. Not rocket science, but something useful to actually see in action, I think, in a country that's managed to get quite far. So thanks a lot for that. Those are the updates for now. I think if you're not on our mailing list, please do, well, certainly fill the attendance register, but also reach out to Zibusiso if you're not on our mailing list. We do try to share tidbits as we get them. Also share your tidbits. If you have information or news that you think is useful to this community, I think we're happy to share that around, and we're even trying to be active on social media, even though we're not the best yet, but we'll get there. Thanks, Professor Fetse. Back to you.
So we needed more
Thanks so much. Like I said, these discussions are always enlightening, but we are now officially 3 minutes over 1 o'clock, and this is supposed to be a lunchbox discussion, so people should be going back to work, I assume. But once again, thank you so much to Dr. Mothobi. Thank all the time to Zibusiso, who is like the brains behind the operations, making sure everything runs smoothly. And we shall see you on the 4th of November, 3rd of November. I'm really excited for that conversation. So thank you so much, and we'll see you all soon.
Thank you.
Bye, everyone.